This video, I'm going to talk about the bond market, or what some call the fixed income market. It's called the fixed income market because it basically provides a um, fixed income. So let's start by talking about um, government bonds. So we could have two types of bonds. We would have corporate bonds and we would have government bonds. The vast majority of bonds out there are government bonds. That's certainly the largest quantity of bonds out there. So let's start with government. Um, Governments issue bonds for a variety of reasons, but most of the time it's because their spending is greater than the taxation, the primary source of revenue, and they make up that difference. Now, that doesn't happen all of the time. It says right here. The book doesn't really even talk about it either, but sometimes the government gets involved in issues that on behalf of another party because they're trying to support that organization. So, one example here in Hawaii would be that the state of Hawaii issues bonds for Hawaiian Electric, which is a corporation, but it does it because it specifically wants to help finance renewable energy. So it does that with a purpose. Um, Typically, when we're talking about government debt on the federal level, if the bond matures anywhere between 1 to 10 years, it's called a note. If it matures greater than 10 years, it's called a bond. For the most part, notes or bonds, they don't pay you very much. They really, truly don't. And that's largely because there's very little default risk involved with them. Now, you can the one big change, probably one of the biggest changes that occurred in bonds issued at the federal level was in 1997 when the U.S. Treasury introduced the TIPS. So what the TIPS do is, as the name implies, um, you get inflation protection that's linked to the CPI plus a um, guaranteed minimum interest rate. And it's generally pretty low. As inflation would increase, then obviously this whole real rate of return, um, if we're talking about anything else, the real rate of return would decrease. What the TIPS does is it stops that real rate of return from decreasing. It provides protection, but that protection obviously will come at some cost. And then we've got the strips, the separate trading of registered interest in principal securities. That would be part of the secondary market. Before we go on to this, let's talk about how would you buy these things? Well, probably the best way, well, you could buy a bond from a traditional broker like my wife, but she'll charge you a super high commission, even if you say you know me. Um, most people most people would just go to treasurydirect.gov. You set up an account and you basically can participate in the auctioning of the securities. That's how the securities are priced. It's a reverse auction. They take lowest price from 100 and build their way up. Um, So you'd go to treasurydirect.gov, open up an account, and let's just see what some of the auctions are that are coming up. So it looks like auction date of Thursday the 25th. They're offering $40 billion in 4-week bills. Also 40 billion in 8-week bills and 35 billion in 119-day bills. Then we have a 5-year note coming up, 7-year note shortly after that. A lot of other stuff. Let's look at the auction results. I mean, look at these rates of return. These are incredibly low rates of return. So when you do this kind of auction, you're not offering the interest rate. What you're doing is saying for a $100 bond, basically people were saying, I'll pay $99 and 99.9611 cents. That's pretty darn close to $100. So you can see how small the margin is there, 0.005% interest for a 4-week bill. I mean, you're making money on the volume. Let's just look at a 30-year. Jeez. We had a 30-year bill issued March the 15th, and people paid up to $90 for $100 a bond for 1.875% interest rate for 30 years. That's not inflation protected. Let's look at the tips, 5, 10, and 30-year. Look at that. For a 30-year bond, inflation protected, people were paying $105 for a $100 bond. In real terms, you'll make a bit more because you'll be adding on the inflation rate, but it's still not that much, reflecting in general a bond market that's just flooded with offerings right now and people wanting to spend the cash for it. And then you've got, besides the federal government, which is the vast majority of the bonds, then you've got the other government and other agency bonds. So the government agency bonds, that would be Fannie Mae, Freddie Mac, those are the biggest ones. Then you've also got your GSCs, government-sponsored corporations like the TVA. That are all issuing bonds. Let's look at some of those. In full disclosure, I do own TVA bonds. Go buy them. Just want to see what bonds we have out there. We have this one that was paying 0.75% interest, maturing in 2025. That was a 5-year bond, issued basically before COVID. Yeah, we don't really have a lot of so with these bonds, what you're getting, like with a TVA bond, what you're getting is you're getting the full faith and credit of the government. So basically, it means that it's pretty low risk portfolio. But with that risk portfolio, you're not going to get very much interest rates, and you'd have to go all the way back to 2008, 2009 crisis to even get a I mean, look at that, year 2000 bond. I mean, look at this beautiful bond. In the year 2000, a bond was issued that was not callable prior to maturity, meaning that the TVA cannot call that back. Maturing in 2030, paying 7.125% interest. And that's just beautiful for that 30-year bond. You got this one, a 50-year bond. Oh, but it's callable. This one's coming due finally, 30 years, only 5 years left, paying 6.75% interest. Again, I don't want to belabor this point here, but um, so we could add TVA, then you got Ginnie Mae, Freddie Mac. Um, these will provide a little bit more interest than a government bond because technically speaking, the federal government doesn't have to back this, but they always have. So there's a little bit of risk, and you'll get a slightly higher interest rate because of that. Then you get your municipal bonds and your state and local bonds. Um, my wife tells me that clients in Hawaii love these kinds of bonds. So you would go to investorrelations.hawaii.gov. And I know there's a Kauai bond coming out here pretty soon. But other ones would be like, the Board of Water Supply and whatnot. Um, Sometimes the state borrows on behalf of, I know it borrowed on behalf of Queens at one point. I know that because I bought it. Hmm. Not seeing too many. Oh, I think there's a I think there's one for the UH. I think it refinanced its debt not too long ago. Yeah. So this is a bond offer where they were refinancing their debt actually. $218 million. AA3, basically stable. This is backed by the state's credit rating. And basically, you'd be issued something like this, that there's bonds being issued back in October that had maturity ranging from this year, 2021, all the way out to 2040. And basically, you would be the first buyer of these bonds. So you'll get them at face value. Then, if you wanted to sell them, you could resell them on the secondary market and you'll get basically the market rate for that item. Now, with a municipal bond, you do have to pay particular attention to how are you going to get paid back from it. Um, are you going to get it back based on the general obligation? Is it a GO bond, a GO bond, a general obligation bond, or is it a revenue bond? So, for instance, a Board of Water Supply bond is going to be a revenue bond because they bring in lots of money and right with monthly bills, and they're going to finance that with the revenue they have coming in for selling water. Whereas even a UH bond is probably going to be a general obligation bond, meaning that it's going to be paid back largely by the state based on its ability to tax the residents and raise money that way. Um, Generally speaking, these bonds are tax free. At least they are exempt typically from that own state's interest, and usually there's a federal income tax exemption as well. So you're getting a tax free rate, meaning that individuals that really like these bonds are basically high net worth bond investors because the tax savings are much larger. Generally speaking, the if you were to buy these kinds of bonds, generally speaking, general obligation bonds are less risky than the revenue bonds, and that's largely because governments basically have an unquestioned ability to raise money through taxation. Whereas you could think of a number of reasons why the Board of Water Supply might not be able to fund its debt if all of a sudden the state were to pass a disconnection moratorium. So they're not going to disconnect your water if you don't pay your bill. Then people don't pay their bill, and now the Board of Water Supply can't pay its bond. There's at least some chance that a revenue bond could you could default on that kind of bond. Now let's talk also then about corporate bonds. So corporate bonds, just like any other bond, we're looking at its yield, we're looking at its price, we're looking at its maturity date. What's going to affect this? Well, the one would be the covenant. Um, what are you allowed to? What is the person borrowing the money? What are they allowed to do during the bond? Can they expand the business? Can they raise prices? Can they merge with other companies? What are the covenants? What are the restrictions, basically? Um, I, for myself, I care more about the call provisions. Um, I don't like callable bonds because basically, um, I mean, the last time I owned a callable bond was City of Philadelphia for their school system. I bought a bond during the height of the 2008-2009 crisis. It was a great bond. And of course, once interest rates started to fall, the bond got called. I mean, I'm not a charity, right? So it's not like I don't like the little kids of Philadelphia. And it's not that I don't want them to learn. On the other hand, when you make an investment decision to buy a bond, you don't want to have to try to predict whether the bond's going to be called or not. So typically speaking, callable bonds are going to be cheaper to buy because you're now taking on some of the risk. I generally don't mind paying for that, and I'll buy a bond that has the call um, um, that lacks the call provision, meaning it's not callable, um, because I don't want to take on that risk that I can't hold the bond till maturity. Then we've got the indentures. The indentures, that's essentially the legal requirements between the bond issuer and the bondholder. What does the borrower, the issuer of the bond, what do they need to do? These bonds that are issued by corporations would typically have an account basically that's used to repay these. That name of that account would be called the sinking fund. And then sometimes people get really excited about certain corporate bonds because they're convertible to equity. Although generally speaking, I don't, I personally don't like that because your reason for buying equity shares in the firm is a very different decision than buying debt in the firm. And if I, as a bondholder, it's just kind of like you got to make a decision as an investor. You can't just be, it's expensive to buy a convertible bond. If you're that like optimistic about the firm's future prospects, then why are you buying the bond? Just buy the stock. Because you're going to pay a lot for that convertibility. Now, as you saw just on the state page here, you saw the three big ratings firms, Fitch, Moody's, and S&P, and giving basically their credit score equivalent, their credit rating, to the different departments that would issue bonds on behalf of the state. Now, Moody's was the first, then you've got the S&P, and then you've got Fitch, all right around the early 1900s, early part of the 20th century. A's are good, B's not as good, C's and D's are bad. After D, you're going bankrupt. Bond ratings aren't everything. The Big Short, the movie The Big Short, does have a lot of scenes because part of the argument behind The Big Short was that the 2008-2009 crisis was in part caused by the credit rating agencies, these agencies. Honestly, bond ratings are used by the lazy. Why would I buy a bond with my hard-earned money based on whether this outside firm gives it an A or a double A? You got to look. It takes a lot of research to buy a bond if you want to do it thoughtfully. You would have to review the company's financials. You would have to review the company's ability to repay that debt. And it's hard to think of a situation where you could just summarize it as A, B, C, or D. As the Big Short movie pointed out, there are some conflicts of interest because basically companies and government agencies have to pay to get rated. And obviously that then creates an incentive for them to get a good rating and to shop their business around to the one agency that will give them the best rating. It's basically a messy business is what this slide is saying here. Then after a bond agency gives the bond rating entity, like Moody's, for instance, gives a letter rating, then they also need to warn before they're going to downgrade the bond offering from, let's say, a double A to a single A. For Moody's, the term would be under review. For S&P, credit watch. For Fitch, rating watch. And if the bond rating agency does this, then those bonds are going to become more expensive to issue, meaning you're going to end up not getting that much of an interest rate differential. the interest rate's going to go up dramatically because now what you have is a riskier investment. And that's basically what this last part's saying here. Let's see who's try to see if anyone Cardtronics, I don't know what that is. Cardtronics looks to be about the biggest one. Cardtronics is getting bought out by National Cash Register, NCR. But already the bonds are BA3. I mean, that's pretty bad. Basically, it's going to become a junkier, even a junkier bond than it already was. The safest place to park your money would be treasuries. And during like COVID, during the financial crisis in 2008, 2009, everyone runs to treasuries and they pull out of corporate bonds and even state and municipality bonds, which I think is pretty dumb because you can actually get some pretty good deals without taking on a huge amount of risk. Yes, a company like Lockheed Martin can go bankrupt. I don't doubt it. But that would require that the US government buys its weapons systems from a company different than it has for the past 50 years, 60 years, which I don't think is going to happen. Now, what you could do if you don't want to buy individual bonds, then what you could do as well is you could buy ETFs and mutual funds that mimic these. Another, I kind of want to talk a little bit now that we're talking about specific things that you all could buy. Well, I don't even think that Robinhood sells them, so maybe I don't even have to talk about them. But if you wanted to buy them, open up an E-Trade account, open up a Schwab account, or even get to make it even cheaper, go on to computershare.com. It's not an advertisement for it, although I do use it. It's not it's not one that we have to worry about. That kind of, I'm not pushing anything here. But what you would have here, what ComputerShare, for instance, does is it allows a way for companies to issue things directly to consumers. They primarily deal with stocks, but the one things they do offer are Israeli bonds. So Israelis actually issue a lot of bonds. It becomes part of the Jewish faith to buy these bonds, so water bonds and whatnot. And so, right, that'd be a way that you could buy those specific bonds. If I want an E-Trade, which again, it's not going to be as cheap as Robinhood, but I think you actually might end up better off at the end of the day. Let's see here. Bonds and CDs. So it looks like here, you can buy US Treasuries at no cost on E-Trade and pay just $1 bond for other kinds of bonds. Looks like they offer everything out there: US Treasuries, agency bonds, municipal bonds, corporate bonds, high yield bonds, those would be junk bonds, and then brokered CDs. Dude, basically get everything right there. Now, all these things you're buying are going to be the secondary market, meaning it was already issued by the agency. You're not going to get too many. You're not going to get too many initially issued bonds. Saying here they've got 50,000 offerings. I don't think they're saying that that's newly issued bonds. Yeah, I don't think so. Okay. That ends our discussion of bonds.